It looks like Santa is not coming to Wall Street. Jared Blikre here with the details and what it could mean for the rest of the year. Today would be the last day of the Santa Claus rally.
Yes.
But it hasn't turned out to be much of a rally.
No, look at all this red on the board. In fact, throughout the entire world, just about. And let's check out the last 7 days, because that is what's key here. S&P 500 down 0.7 today, and it would be down 79 basis points, or about 0.8% over this time period. But why is that important? That's because this time of year, and really it is the last 5 days of the previous year and the first 2 days of the current year. And you can see here, I have these blocked off. That constitutes the Santa Claus rally. Usually it's good for 80% of the time, it's good for 1.3% average gains. However, when it turns red, that is an indicator that we might have negative returns for the entire year. And in fact, the Santa Claus rally indicator, and that's what it is, an indicator, if you combine it with two other January-based indicators, which we won't know the results of those until the end of January, those have very, very predictive power for the rest of the year. And if all three are negative, that would mean an 87% chance that the year ends red. And just take a look at what we have going on here. Throughout the entire year, or last year, at the beginning of the year, rewind a little bit, we were actually finishing January 2nd, January 3rd in the green. And look what happened. January was a very green month, and to the surprise of many people, myself included, it ended up being a very, very bullish year. So having said that, I thought we'd go to the sector action and just kind of break down what we've seen over these last 7 days, because I think this has a lot to say about the character of the rally as we find our footing in the new year. All right, over the last 7 days, check out who's winning here. Healthcare, XLV, that's up 3.1%. Then you follow that with utilities, staples, energies, financials, all of those in the green there. But the top three are pretty defensive sectors, especially staples and utilities. Healthcare, kind of a mishmash there, but you could make that argument. Now, you look at what's not working over these past 7 days, that would be tech and retail. That's consumer discretionary. Those were two of the three best sectors from last year. You add communication services, and that's over here, which is also in the red. You get the mega cap sectors. So looking at the NASDAQ 100 over these 7 days, if there's any predictive power, and we'll see there, we get a screen change, this would not look good for the entire year. And just, I don't want to get too ahead of myself. As I said, we still need to get results for the end of January, but as we're sitting here, second day of the year, things are looking not as bright as they were at the end of last year.